I'm Greg Hunter. Welcome to USAWatchdog.com. With us, coming on a two-time, hopefully a three-time best-selling author, her brand new book, Collusion, How Central Bankers Rigged the World. And listen, this is no just Nomi Prins, of course, I'm giving it away. This is just no charge off the top of her head. In the back of the book here, and I counted up the pages, there are 97 pages of footnotes and sourcing for that support this book. Just unbelievable. Here's a picture of Nomi. But why have a picture where we can get the real thing? Nomi Prins, thank you for joining us while you're on your book tour out in California. Thanks for joining us. All the best to you on the book. I know you sold a bunch in the pre-orders of the book Collusion. You traveled, and I know this because I interviewed you a few months ago. You traveled all over the world. I mean, you were on every continent with the exception of Antarctica, I believe, putting this book together. How bad did it have to be for the central bankers to all get together and collude to prop the system up?
Well, first of all, thanks for having me on, and thanks to your viewers for being really supportive. The last time I was on in the pre-order period, thank you, Greg, for everything you do. It was bad, as we know, in the financial crisis of 2008. And what I did in the book is I went to all of these places in the various chapters, Mexico, Brazil, China, Japan, Europe, and so forth. And I kept going back to 2008 and going forward in the country or region, going back and going forward in time to show that the financial crisis created this momentum for the major central banks in the world to completely go off the rails in terms of fabricating money, conjuring money, going about quantitative easing, keeping the global interest rate at 0%, even though the Fed has raised rates a little bit, for the past 10 years. Why? Because the U.S. financial system, with some help from other banks in other countries, but predominantly the major Wall Street banks, decided to decimate the financial system. When I say decide, some of that might have been by accident in the beginning, but what happened was the toxic assets they created, the trillions of dollars of money they lent to other institutions and countries to buy those toxic assets, created a $140 trillion mess between the assets and the leverage in the fall of 2008. And it is from that we are into this new normal in the world where central bankers and the major central banks in particular are the markets. They have subsidized the financial system, and it's an ongoing policy.
When you say they are the markets, so in other words, it's still bad. Basically, and isn't it really worse? I mean, 140 trillion back in 2008. I think the global debt is 237 trillion, something like that. I mean, it's huge. Is it not?
It is huge. It's between 2.5 and 3 times global GDP, which is a historical high. Debt to GDP throughout the developed world is higher than it's ever been, and it continues to grow. Why? Because money has been conjured up and rendered cheap for the participants at the top of the financial system, the banks, the major corporations, the people who make money out of that, and it hasn't washed down to the rest of the economy, which is why most people feel this anxiety about a potential financial crisis, but also about what happens every day in their own pocketbooks. And so it is worse. These central banks currently, today, 10 years after the financial crisis occurred, and supposedly after an emergency situation to central banks was taken care of, have on offer $21 trillion worth of conjured money in return for debt assets, stocks, and corporate bonds around the world. If they pulled that plug, if they were to take down any of that 21 trillion, even a little bit that the Fed's talking about tapering, and they're doing it very, very gingerly, but then other central banks are coming in and adding to it. So if they took down any of that money, it would begin to create a major rupture in the financial system. And that's why I say that central banks are the market. Without them, the market would be nowhere near these highs. And if they were to pull their help and their subsidies, the market would plummet really quickly.
Yeah, but let's say they keep going. So in other words, if they pull it, the market crashes. But if they don't pull it, doesn't the market still eventually crash at some point? I mean, this is a long, crazy scientific financial, monetary, scientific experiment, and nobody knows the outcome. If they continue doing it, don't we still get a crash, or am I wrong?
We will eventually get a crash because at some point, the amount of quantitative easing, the amount of conjured money to buy assets out of the market to pump up the financial assets, the financial system, will come to this head where even though these major central banks are continuing to dump money in, the ruptures at the bottom of the economy, the corporations that even though they're borrowing cheaply just can't make enough to even service very cheap debt, and consumers who are at all-time debt highs don't have enough to continue to furnish their debt, and things happen at the same time in terms of lack of payments and delinquencies and defaults, then the financial system seizes up, then money gets taken out of the stock market to sort of plug the gap, and then the stock market comes down. So it starts with debt disintegrating or defaulting or having delinquencies, and then it goes into the stock market, and then goes into real estate market and so forth, because that's really the cycle that we'll see. That's the cycle that we had last time, even though it was the mortgage market, the subprime market that was at the core of the financial crisis. But the behavior that happens after is a sort of seizure of credit, a fear amongst the participants, amongst the banks, lack of confidence everywhere, and the central banks have now dumped all this money in and made rates on average still 0% throughout the developed world, don't have a lot of powder left in their keg to continue to do what they're doing. They'll keep this game going as much as they can. And I have graphs on my Twitter that I put out at Nomi Prins where you can see the sort of line continuing to go up. In terms of what they're continuing to dump collectively in the market. That's why I use the term collusion. It's not just the Fed, it's them working together. But when there are cracks, they start to get bigger and bigger faster. That's when we have a crash.
I bring this up because this is one of the biggest stories I thought, one of the biggest financial stories, and I think on purpose they didn't cover it. The Puerto Rican debt crisis. I mean, $74 billion in bonds that they just said, sorry, we can't pay. 74, the 3 million people, and I tell people this all the time, and North Carolina has about 10 million people. We got about 4 billion in debt. Puerto Rico has about 3 million people. They have 74 billion in debt. I think it's totally fraudulent. But on top of that, I mean, they just couldn't pay. Is the world heading for one big Puerto Rican moment in terms of their financial system? And I love Puerto Ricans, and I love Puerto Rico, but their leaders screwed them. But is the world heading towards one big Puerto Rico debt default moment?
Well, ultimately, what's happening now and what's happened since the central banks went into this unprecedented, what was supposed to be emergency policy of quantitative easing in different permutations throughout the major countries, is that they've been lifting up those major countries. And so that means when something happens in Puerto Rico or something happens in Greece or something happens in Peru or wherever it is, that there's no money to handle that. There's money to handle JP Morgan Chase. There's money to handle Goldman Sachs. There's money to handle Wells Fargo, even though it continues to basically steal money and cars and other things from its customers on a routine basis. That choice was made. And has become more of the new status quo in the wake of the 2008 crisis. So ultimately, yeah, we're pushing onto a cliff. I think of the example of the Titanic, right? So the Titanic ultimately went down, and most of the people on it died. But before that happened, there were life rafts. There weren't enough life rafts, but they were available for sort of upper elite class. And so as the ship was sinking, after hitting the iceberg, the sort of richer people in upper class, some of them managed to get into the boats that were available, and everyone else basically sunk with the ship. And so that's kind of what's going on, is ultimately at the top of the system, people and entities will be able to sort of get out and sort of sail away in the cold perhaps, but the rest of the system has that propensity to go down beneath the water, to crash. And so that's the problem. Right now, they're keeping it together. Right now, that line is continuing to go up of money that's being dumped in and conjured to provide this sort of life raft for the financial system, and it's lifting the markets in the meantime. But the countries that don't have the life rafts, that didn't have the life rafts, are going down or will go down more quickly, especially if rates start to go up and there's too much of a tightening too quickly, and all of a sudden all of that sort of up move does start to crack. But then ultimately, once that happens, then the top of the system cracks.
You say in your book, it only takes one domino to fall to wipe them all out. Explain.
So if we remember the subprime crisis, what happened then was that there was $500 billion worth of subprime loans, and they ultimately lined $14 trillion of toxic assets, which were then leveraged, or sort of entities borrowed money from the banks that created these assets in order to buy more of them, to that 140-ish trillion dollar number. That's kind of what was at risk in the system between the borrowing and the assets themselves. So what happens, like one town has a bunch of defaults, another town has a bunch of defaults. It's not the individual's fault. They themselves can't bring down the system. But what brought down sort of the system, what created the financial crisis, was that all of those loans were lining so many more assets, and so much money was lent on top of those assets that little house somewhere in, say, Stockton, California, whose homeowner might not have been able to pay that mortgage on time, and who ultimately defaulted on the mortgage, whether that was through a fraudulent mortgage or whether that was for, because of economic uncertainty in that person's life, that loan was expected to line or contribute a little bit of interest to all of that 140 trillion, because a lot of what was created was all sort of codependent. So when one of those stops paying, when one corporation somewhere stops paying, and then they don't pay bills to another one, and expenses get cut and jobs get cut, and people don't have as much money to go next door and buy whatever it is they used to buy, that's when things again start to unravel.
Deutsche Bank, Wells Fargo. I mean, I've been telling my friends, I said, nobody commits that kind of ripoff and, takes loans out and charges fees. Nobody does that unless they're capital impaired. And Deutsche Bank is laying off, I don't know, up to 500 investment bankers, Deutsche Bank. Are those just the cracks in the system that you're seeing that show that the economy is not fixed and it's still in deep trouble?
Yeah, so Deutsche Bank is primarily firing people in Europe, but they're predominantly closing up a lot of business in the United States, which actually has the side effect of increasing the business in the U.S.-based companies that were subsidized and are still subsidized by the central banks like Goldman and JP Morgan and so forth. But yeah, what happens is most of the investment bankers that get cut, or actually bankers that get cut, because a lot of people within these massive institutions get cut from the bottom up. They don't necessarily get cut from the top down. And so in a way that preserves the money that's coming into sort of senior management by taking it from sort of middle management or possibly lower level workers. And so that's kind of what happens. Yes, when a system starts to go under, a corporation tends to keep its very top, and it tends to get rid of people at the bottom. And, we see that in other sectors. I mean, we see that in the retail sector with things closing up and thousands of people getting fired and so forth. All of those people, especially if they have debt, and especially if that debt is somehow securitized or in other types of assets, are part of the sort of artificial system that has been subsidized by this central bank policy. If you look at how just the stock market has risen over the last 10 years, when it's risen the most and so forth, there's like a direct line that's right under it or next to it of quantitative easing policies collectively throughout the main central banks, the Fed, the European Central Bank, Bank of Japan to a lesser extent, the Bank of England, Switzerland, and so forth. And that's lifting. But when companies go under, when people can't pay, when small businesses can't pay, when medium businesses can't pay, that's when debts default, that's when people get fired, and that's when there's just more hardship bearing on the economy. The people at the top will try to get out as quickly as they can, like those people in the life rafts. And that's what they're doing now. One of the other signs that this is starting to happen is that a product called CLOs, which are collateralized loan obligations, which are just basically collections of loans that were made because there was so much cheap money available to many corporations, are being sort of scooped up and aggregated, just like happened to subprime loans into the last crisis. And that's a sign that the faster they get scooped up, and there was a record issuance quarter just this past quarter, it means that banks are trying to kind of churn the sort of waste or the things that might be more problematic to them off of their books into new assets and selling them off. So when we start to see that accelerate, it's usually a sign that banks know, because they have this information firsthand, just like they had subprime loan information defaulting before the rest of the market knew about. They know if corporate loans are defaulting. They know if they're missing a payment or two here and there. They know if they missed a payment, but then they repaid and then they missed the next payment, that something's going wrong. And so what they're doing is trying to scoop that up, re-rate it as AAA, just like last time, and sell it off so that they can make as much money as possible before things go down. And the central banks are just helping them in this process by continuing to subsidize them with cheap money.
And you think the central banks and the bankers, because of these signals, they all know that time is short for the next big crisis, which is it going to be bigger than the last one? I mean, there's more debt than the last time. Well, so the banks know that a big crisis, another bigger than the last time crisis is coming.
I don't know if they fully comprehend that, how big it can be. I mean, if you look at the numbers, if you look at how much debt has been accumulated in the last decade, if you know, which all these central banks have to know, that if they were to pull the plug and actually really unwind their books, which they won't do because of how bad it would be if they did, that's a really big sign that the system itself is really very unstable. And that's why, and one of the things I do in the book, and I go to different countries and I had researchers on the ground so we could analyze what the media was saying about what central banks were saying and then what they were actually doing, and sort of put the timelines on top of each other. And what you find, even when you look at what the Fed's saying versus what it does, is every time they say something sort of positive about the economy, because after all, they have to behave as if this process has been successful, because the idea was it was an emergency sort of gift, but it was supposed to help the main economy. That's how it was sold everywhere. And if they know it's not really working, they all look pretty bad. And these people are invested at the top of the central bank, and the financial system, the political system, and not looking bad, or at least retiring or going somewhere else before everything gets bad again. So it's not like they don't know. I do think they're unaware as to how much or how badly things could be, because even though they're colluding together to keep the system up, it's not really clear that they're looking at everyone else's information all the time in terms of what's coming in, like how loans are deteriorating or how CLOs are expanding, and just putting that together. They tend to be in this avoidance mode, as they were last time. Ben Bernanke in 2007 said, no, housing's fine. Treasury Secretary at the time, Hank Paulson, was like, everything's great. So they tend to also act in denial.
You traveled the world in this in your book. I'll hold it up again. Collusion, brand new book, just out just recently. You traveled the world, and just your opinion. When it blows, you think it will blow. Is that right?
Yes.
Okay, so when it blows, I don't want to put words in your mouth. When it blows, is it going to be worse than the last time, given the fact that you just went to 6 of the 7 continents on the planet? And will it be worse than the last time?
It will be, because we're falling from a higher height. So it's the idea that you're sinking the Titanic versus sinking like a canoe somewhere, because all of this artificial conjured money is really what is puffing up the system, and money that's borrowed on top of it cheaply is also puffing up the system, creating asset bubbles everywhere. So when things do pop, there's just more to. There's more leakage to happen. The air that's in all of these bubbles has created larger bubbles than we had before the last financial crisis, and so that's what will look better. And so when I go around to different countries, and each of them had, or different continents, each of the places that I visited, the idea was not simply to travel around and collect air miles, which I also did, but it was to take a look at how the economies that didn't do what the Fed was doing, and why they didn't from a central bank policy, looked like at the time, and have looked like since. For example, Mexico, I opened the book with a story about how Guillermo Ortiz, who was the head of the Central Bank of Mexico when 2008 happened, and he went up and he said, he went to Washington and he visited with Ben Bernanke, chair at the time, and he said, look, I've been here in Mexico through a financial crisis, 1994, the tequila crisis, peso crash, banks closed, people were thrown out of jobs, it was really bad. But what you need to do, and what I learned, is that you need to create confidence in the sort of system itself for people relative to the system, and not simply help the banks, because otherwise you're just pushing the problem forward. And Ben Bernanke basically sort of ignored him, continued with the process of quantitative easing, bringing other central banks into that fold, because the dollar is the reserve currency, and it's important that, because these banks are codependent, that money is cheap everywhere, and so capital doesn't sort of flow too quickly out of the U.S. and so forth. But then Mexico had a big economic crisis, and they've tried to keep rates a little bit higher better so that they don't have inflation coming out of that crisis, so that people can afford to, do things like buy food. And so that they had to break away from the Fed. And as central bank leaders broke away from the Fed's policy in places like Mexico or places like Brazil, they got really punished politically for not sort of doing what the Fed was doing. But if they had done what the Fed was doing and made money as cheap in those kinds of countries that are different from an economic structure, it would have hurt their people more. So that's what happens when things also implode globally, is that the countries that are sort of more on less stable ground to begin with, they're the ones who get hurt most in the beginning, and then it sort of moves to the center. Certain countries like Japan, for example, it's basically not had any inflation for a very long time, has had the most amount of quantitative easing in the last 3.5 years relative to the Fed. So if you look at that cumulative 21 trillion number, they've done more recently. The Fed did more in the sort of initial part of these 10 years, but they're working together. So it's still the outside countries, the developing countries, the emerging market countries that get hurt first. The people at the bottom of the major country economies that get hurt next, and then ultimately it hurts the financial system that's been the recipient of all of this cheap money.
Do we get a new financial system when this blows? Is there any fixing the financial system that we see today?
The problem is the financial system we see today is completely predicated on all of this money. If you start to unwind the money or raise rates too quickly of any of the major central banks, you accelerate this coming of this potential crisis. And the only way to really get around that, and this is something I touch on in the book from having visited these different countries and just looking at sort of the agreements that were being made outside of the dollar, outside of the U.S., is that in the wake of the financial crisis, for example, China, the People's Bank of China, the leader there, Governor Zhao at the time, became very public about his concerns that what the Fed was doing was going to create too many bubbles, and that was going to create a sort of unstable market and an unstable financial system. And so he started, and China started, because they're very closely connected, the People's Bank of China and the government of China, to create trade alliances and currency relationships with other countries in Southeast Asia, with Russia and so forth, so that they could effectively hedge themselves against the risk of not just the dollar as the world's main currency, but also the policy that backed the dollar, which is the Federal Reserve propping up the U.S. banks and then, sort of exporting or colluding with other major banks to continue to do that globally. And so all of these other trade agreements are an alternative. All of the other bonds that get issued in currencies that don't include the dollar are an alternative. The IMF, including the Chinese yuan in the SDR, in the special drawing rights basket, as a sort of average kind of a currency, and issuing more bonds in that currency. They're all alternatives. Cryptocurrencies are alternatives. So all of these different mechanisms and geopolitical relationships have accelerated or risen in the wake of what the Fed and the U.S. financial system did to the world. And ultimately, it will take time. I mean, this isn't the kind of thing where, and this gets rumored, where all of a sudden China is going to sell back all its treasury bonds and tank the dollar and everything else. No, they're invested in them. They sell the bonds, they lose money too. So all of this takes time to play out. But these trade alliances, Europe and Japan, all of these are happening in order for countries to disinvest from dollar-based transactions.
How long do you think this can go on for?
We've talked about this, and I used to think that it would be until there was an unwind, and I still believe that. In other words, not just the Fed saying we're not going to reinvest coupons that are coming in, or sort of interest payments that are minor anyway, that are coming in from the book of assets that we've amassed, and raise rates a little bit, that they've done once in 2015, once in 2016, 3 times last year, and so far 1 time this year, that it would accelerate, and this would crash or bring about a crisis more quickly. But as I keep looking at the data, and I keep looking at this overall line going up, I think there's a need to wait until it starts to at least level off, this line of continuing globally to have quantitative easing be the monetary policy throughout the world. And that's going to take time. The European Central Bank was going to stop buying bonds last summer, and I would have thought that would have been when a crash happens. And we talked about that before that, that would be a pivotal point to watch for. The reality is they then upped their program. They extended their program. And this year, they said they were not extending the program. The mainstream media talked about them tapering their program, and then they turn around and say, yeah, but we're lengthening it. So they're continuing it. They might be continuing it more slowly, but it's going on. As long as it goes on, we have to look for these other cracks to come in. The bonds starting to default, delinquencies coming in, these CLOs starting to crack, and so the timing, I'm not sure, but it will be when those two things come together, the plateauing of the buying of assets, of the end of quantitative easing, not just one central bank tapering or saying they're going to taper, and this increase in defaults and delinquencies. And again, at that meeting point, and whether that's in a year or in 2 years, or we start to see, which was what we're doing, more volatility in the market along the way, the highs and lows on a daily basis, that much grander, 500-point drops, 1,000-point drops occasionally on the days where the Fed says it's going to taper by more, or says it's going to raise interest rates, and then they come in and back off and change the language and say, no, we didn't really mean it. That's going to continue for a while.
How do you protect yourself? How the normal guy says, oh my God, this woman just went around the woman, ran around the world, excuse me, and did all this research. And how does a little guy, in St. Louis, Missouri, or in Tioga, North Dakota, how do they protect themselves?
They have to own things, and by that I mean real assets. By that I mean a portion of hard assets like silver and gold, but that's not as liquid. So actually taking cash out of banks, sort of keeping it in real things, keeping it aside, even physically out of the major banking system, whether that's just putting into local community banks as some sort of a safeguard, but sort of extracting it from the system, because the reality is when a financial crisis happens, banks start to close their doors to their depositors. And we still are in an environment in the United States and throughout the world where the deposits of real people line the banks. They have subsidies from the Fed. They have stock buybacks that they've been doing because of that. They have new tax breaks, which sort of enhance their ability to buy their own stock. And at the same time, they also have the collateral of deposits and loans to keep them going and to use as hostage in the event of another crisis. So we need to, the average person on the street, and I've done this as well, is take more cash aside, have more sort of long-term crisis-related assets aside as well. I'm not saying put all your money in gold, but certainly a small percentage in that as well, and to buy things that you can use. And I always say this, to basically try to decrease your debt so that when things get bad, when rates go up, you're not stuck with variable rate types of debt that will then sort of fly in your face. So a way to preserve money and actually grow your portfolio is to shrink the amount of debt you have, if you can, going into that.
The people have said the same thing, and we're going to cut it off right there. I got to tell you, I really appreciate you stopping what you're doing. I know you got a big shindig tonight, and you're on your book tour. And let me just get you front and center here. It's the book right here, Collusion, Nomi Prins. I'm not going to offer the Amazon link because they get enough traffic already. I'm only going to offer the link to your site, nomiprins.com. You cannot miss the book. Go there and click through to buy the book if you are desire to do that. Nomi Prins, thanks for joining us today on USAWatchdog.com. And please keep me informed. So when you become your third-time bestseller, which is All the President's Bankers, I believe, and then It Takes a Pillage, when this becomes, there you go. When this becomes a bestseller, I'm directing. I empty the trash. I do everything. When this becomes a bestseller, which I hope it does and probably will because it's very interesting. Again, 97 pages of sources and footnotes. You did a lot of work on this. Tremendous job. People are going to get their money's worth. Nomi Prins, thanks for joining us today on USAWatchdog.com.
Thank you.